Home prices did something nobody expected. Interest rates went up, borrowing got more expensive, and by every rule of basic economics, prices should have crashed. They didn't. In most places, they barely moved. And that mystery prices refusing to fall the way textbooks said they should tells you almost everything you need to know about how the housing market actually works, and why so many people feel permanently locked out of it. To understand what happened, you have to rewind to the years everyone remembers for the wrong reasons. During the pandemic, something strange happened to human behavior around housing. People suddenly needed space, a home office, a bigger yard, distance from neighbors. At the exact same time, interest rates dropped to levels nobody had seen in decades, which meant the same monthly payment could suddenly buy a much bigger loan. Cheap money plus a sudden psychological need for space created a buying frenzy that pushed prices up faster than almost any period in modern history. Then the response came. To fight inflation, rates were hiked aggressively and repeatedly. On paper, this should have cooled the market instantly higher. Rates mean higher monthly payments, which should mean fewer buyers, which should mean falling prices. That's the textbook version. Reality had a different plan. Here's the twist almost nobody saw coming. Instead of crashing prices, higher rates froze the market completely. And the reason comes down to something called the mortgage lock-in effect, which is really just human psychology wearing an economic disguise. Millions of homeowners had locked in historically low rates during the cheap money years. Selling their home now wouldn't just mean finding a new place to live, it would mean giving up that low rate and taking on a new mortgage at double or even triple the interest cost. So instead of selling, they simply didn't. En masse. Inventory dried up, not because nobody wanted to sell, but because nobody could afford to. This is the part that trips people up. A housing crash usually needs sellers who are desperate or forced to sell. But this time, the sellers who existed pre-pandemic were sitting on the best mortgage terms of their lives, with zero incentive to give them up. Low supply, even with weaker demand, is still enough to keep prices propped up. Basic supply and demand didn't break, it just got hijacked by an incentive nobody accounted for. And this is where the generational squeeze comes in, because the people paying the real price for this frozen market are the ones who don't already own a home. Younger buyers face a brutal combination: home prices that never corrected, interest rates that are still historically high compared to the last 2 decades, and a shrinking pool of available homes because existing owners refuse to sell. It's not that this generation is worse with money or less disciplined than the ones before it, it's that the entry price into the game has quietly doubled while the rules of getting in got dramatically harder. Zoom out further, and there's an even bigger structural problem sitting underneath all of this: a long-term supply deficit that's been building for over a decade. After the previous major housing crash years ago, construction of new homes slowed dramatically and never fully recovered. Builders got cautious. Regulations got tighter. Land got more expensive. For years, the country was quietly building fewer homes than population growth actually required, and that gap didn't disappear, it just kept compounding silently in the background, waiting for a moment like this to become impossible to ignore. So where does that leave the market now? Somewhere between stability and illusion. Prices look stable on paper, but that stability isn't coming from healthy supply meeting healthy demand, it's coming from paralysis. Sellers who won't sell. Buyers who can barely afford to buy. A market that isn't functioning normally, so much as it's frozen in place, waiting for something to force it to move again. Looking forward, there are really only a few ways this unfreezes. Rates could fall enough that locked-in homeowners feel comfortable moving again, unfreezing inventory naturally. New construction could finally catch up to the years of underbuilding, though that takes years, not months. Or affordability could keep stretching until something else in the system breaks under the pressure. None of these are quick fixes, and anyone promising a fast, simple prediction is usually selling something. For anyone trying to actually navigate this instead of just watching it from the sidelines, the strategy isn't about timing some dramatic crash that may never come. It's about understanding the actual mechanics at play: rates, lock-in effects, and supply, instead of reacting emotionally to headlines that scream "It's over" every time a chart wiggles. Panic-driven decisions in a market this misunderstood tend to cost people far more than patience does. Because here's the real story underneath the numbers: this isn't really a housing story. It's a psychology story wearing a housing market costume. Millions of individual, rational decisions: homeowners protecting a good rate, buyers waiting for a better moment, builders avoiding risk after getting burned before, added up to a market that behaves nothing like the simple supply and demand chart everyone learned in school. Understanding that isn't just interesting. It's the difference between reacting to headlines and actually understanding what's happening to your own biggest financial decision.